You open your brokerage app. You decide it's finally time to step up and be a truly savvy investor.
Right, time to get serious.
Exactly. So you buy this massive, highly recognizable U.S. tech ETF.
Oh, yeah.
You brush your hands off, sit back, and think, boom, I am globally diversified.
But, are you?
Right. Are you really? Welcome to today's deep dive. We are looking at a remarkably sharp, uncompromising set of notes based on financial expert Devina Mehra's presentation at the ET Alpha Wealth Summit.
That's a fantastic source. Really eye-opening stuff.
It really is. And our mission today is to completely tear down that illusion of the prefix global portfolio.
Yeah, that illusion is everywhere.
We're going to show you why buying an American brand name isn't actual global investing, how to avoid the really dangerous traps of financial packaging, and ultimately how to build a portfolio that actually survives an economic storm.
And it is a critical conversation to have, especially right now. Because the way most investors, particularly domestic Indian investors, approach the international markets is just fundamentally backward.
How so?
Well, they're treating global investing as a tactical reaction, like an escape hatch, rather than what it really should be.
Which is a structural foundation.
Precisely. A structural foundation.
Let's unpack that right away. Because before we even debate where you should be putting your money across the globe, we have to establish why you're doing it in the first place.
Right. The why is everything.
And the sources make a very firm assertion right off the bat. They say investing globally should never, ever be a knee-jerk reaction.
Exactly.
But, to be honest, that is exactly what we see happening all the time, right?
It's incredibly common. The domestic Indian markets will have 1 weak year.
Or, honestly, even just a choppy, volatile quarter.
Right. And suddenly panic sets in. Investors look at their red screens and say, get me out of here.
Yeah, they're like, I need to move my capital overseas where it's safe.
Exactly. That is reactionary investing. It's driven entirely by emotion, by fear.
And emotional investing is, well, it's almost always a guaranteed recipe for buying high and selling low, isn't it?
Oh, absolutely.
Yeah.
You are fleeing a temporary dip in one market to buy into another market that might already be, peaking.
Right, you're just chasing yesterday's returns.
Exactly.
So if we strip away all that emotion, right, and we say it shouldn't be an escape hatch for a bad quarter.
Right.
What is the actual logical, structural foundation for going global? The notes present a statistic that is so simple, but it completely stopped me in my tracks.
The market capitalization reality.
Yes. India accounts for less than 3% of global market capitalization. Less than 3%.
I know. When you really sit with that number, it completely shifts your perspective.
It's staggering.
It means 97% of the investable wealth, 97% of the corporate innovation, the breakthroughs, the earnings of the entire world.
All of it exists entirely outside of the domestic Indian market.
Precisely.
To put this in perspective for you, imagine your investment journey is like walking into this massive, sprawling, multi-story shopping mall.
Okay, I like this.
Right. It is filled with thousands of incredible things to buy representing the entire global economy.
Right.
But by keeping your money solely in Indian markets, you are essentially refusing to shop anywhere except the very first 2 stores right by the main entrance.
That's a great way to visualize it.
Now, those 2 stores might be fantastic. They might be highly profitable, growing businesses that you love.
Sure.
But you are willfully ignoring 97% of your options.
And, it's not just about missing out on the opportunity to shop in the rest of the mall.
What else is it about?
There is a deep, defensive mathematical logic to venturing out into that broader 97%.
Okay, lay it on me.
The notes highlight the long-term reality of rupee depreciation.
Ah, right.
And this is crucial, right? Because this is not some pessimistic critique of the Indian economy. Not at all.
So it's not a political thing?
No, it is just a macroeconomic reality tied directly to inflation differentials between emerging and developed markets.
Okay, let's pause there for a second. Walk me through that mechanism.
Sure.
Because inflation differentials sounds like, textbook financial jargon. How does that actually destroy an investor's purchasing power?
It's a mathematical reality tied to how currencies balance each other out over time.
Okay.
Let's simplify it. Imagine inflation in India averages around, say, 5% over a decade.
Right, just as an example.
Right. While inflation in the United States or Europe averages around 2%.
Okay, so there's a 3% gap.
Exactly.
Right.
That means the cost of goods in India is rising faster than the cost of goods in the U.S.
That makes sense.
So over a long enough timeline, the Indian rupee mathematically has to lose purchasing power relative to the US dollar.
Just to balance out that 3% difference in inflation.
Exactly. The currency depreciates to maintain economic equilibrium.
Ah, so it's practically physics. Like you said, it's not a political statement. It's just the math of inflation.
It really is. So if you are an investor and you only hold rupee-denominated assets,
Your global purchasing power is slowly, invisibly leaking away year after year.
yes. But if you step out into that 97% of the mall and you own hard currency assets,
Like investments denominated in dollars, euros, or pounds?
right, if you hold those, you create a natural structural shield against that leak.
Wow, okay.
As the rupee mathematically depreciates, the value of your foreign assets automatically increases in rupee terms.
Oh, so it is literally a built-in hedge for your wealth.
Exactly.
Okay, so the foundation is rock solid. We're currently ignoring 97% of them all, and we desperately need a structural shield against inflation and currency depreciation.
Right.
So you, the listener, you hear this, you agree. You step past those first two stores by the entrance and you finally walk deep into the mall.
Good for you.
But here is where we hit the most common and, frankly, the most dangerous trap in international investing.
The trap of confusing the word global with the word American.
Yes. You walk past the entrance, and instead of actually exploring the diverse global mall, you just walk straight into the giant neon-lit American megastore in the center.
And you just sit down in the tech aisle and you refuse to leave.
Right. The notes explicitly warn against this. True global diversification is not just buying a NASDAQ ETF or an S&P 500 fund and calling it a day.
No, it's not. But it's a very comfortable trap to fall into, you know.
Because the U.S. market is so incredibly dominant in the financial media.
Right. It feels safe because it's famous.
But I'm going to push back here just to play devil's advocate for you, the listener.
Okay, go for it.
Because I know exactly what the counter argument is here. You're thinking, wait a minute, the U.S. market is the biggest in the world.
True.
And if I buy an S&P 500 index fund, I'm buying companies like Apple, Microsoft, Google.
These massive multinationals.
Right. They sell iPhones in Mumbai. They sell software in Tokyo. They run servers in Europe.
Yeah.
So aren't those companies effectively global anyway? I mean, their revenue comes from all over the planet. Why overcomplicate my life by trying to buy stocks in other countries?
It is the single most common defense of the U.S.-only strategy.
Really?
Oh, yeah. But it misses a fundamental mechanic of how stock markets actually work.
Okay, what are we missing?
What's fascinating here is that revenue source does not equal market cycle exposure.
Wait, what do you mean by that? Revenue source doesn't equal market cycle exposure.
Okay, yes. A U.S. tech giant sells products globally. Their revenue is diversified,
Right.
but its stock price, the actual asset you own,
Yeah.
its stock price is heavily, heavily dictated by the U.S. economic environment.
Oh, I see.
Specifically, things like the U.S. interest rate cycle set by the Federal Reserve, the U.S. regulatory environment, and the daily sentiment of massive U.S.-based institutional investors.
Okay, explain that causal link for us. Why does an interest rate hike in Washington, D.C. hurt a tech company's stock if they are, still selling millions of phones in Asia?
It comes down to how stocks, especially tech and growth stocks, are valued.
Okay.
Stock prices are based on the present value of future earnings.
Right, the discounted cash flow.
Exactly. When the U.S. Federal Reserve raises interest rates, the discount rate applied to those future earnings goes up.
Okay, so the math changes.
Right. Mathematically, it makes the profits those companies expect to make 5 or 10 years from now worth less today.
Got it.
So if the U.S. Fed aggressively hikes rates, that U.S. tech stock is going to take a massive hit to its valuation.
Regardless of how many iPhones they successfully shipped to Europe that week.
Exactly. You are entirely captive to the economic weather of one single country.
Wow. Okay, so even if the business is global, the stock price is hyper-local to the U.S. economy.
Precisely. And this leads to Mehra's crucial point about market leadership.
Okay.
The core reality of global finance is that market leadership rotates.
Rotates how?
It constantly shifts across different countries, different geographic themes, different sectors, and different asset classes over time.
So the United States is not always the winner.
Not at all.
It certainly feels like it has been lately, though, which is probably why everyone is crowded into that trade.
It feels that way if your memory only goes back like 10 years.
True.
But if you look at historical cycles, this rotation is undeniable.
Give me an example.
Let's look at the lost decade, for the U.S. market.
Right, from roughly the year 2000 to 2009.
Exactly. If you bought that U.S.-centric S&P 500 fund at the start of the decade, you endured the dot-com crash, a sluggish recovery, and then the 2008 financial crisis.
Ouch.
Yeah. For 10 solid years, your U.S. index fund essentially generated zero returns.
Zero returns in a decade.
It was a brutal decade for the American megastore.
But the rest of the world wasn't standing still during that exact same period.
Not at all.
Yeah.
While the U.S. was suffering its lost decade, emerging markets were undergoing a massive historic boom. Oh, yeah. Countries like Brazil, Russia, India, and China were delivering incredible returns.
Driven by what?
A global commodities supercycle and rapid industrialization.
Okay, wow.
If you were only in a U.S. tech ETF during that decade, you missed out on one of the greatest wealth creation cycles in modern history.
So you were basically making a massive, concentrated bet that the specific economic weather of the United States would outperform the rest of the planet forever.
Exactly. And that is not diversification.
No, it's not.
That is a concentrated bet disguised as diversification.
Disguised as diversification, I love that phrasing.
Yeah. True structural allocation means having exposure to those rotating cycles.
Right.
When the U.S. market inevitably cools down, and history tells us it will, perhaps Latin American commodities or European industrials or Asian logistics are heating up.
And you want your portfolio positioned to capture that rotation, not be a victim of it.
Exactly.
Okay, so I take your point. I am convinced the American megastore is not enough.
Glad to hear it.
I need the whole mall. I need European industrials. I need Asian tech. I need real exposure outside the U.S.
Yeah.
So I decide to go buy a complex global fund to do this for me.
Makes sense.
And right now, the financial industry is heavily pushing these shiny new things called gift city wrappers.
Ah, yes.
It feels like the easy button. But based on the tone of these sources, I'm sensing a trap here, too.
You have good instincts.
Yeah.
The financial industry always senses demand.
Yeah.
And they are incredibly quick to supply the packaging.
Packaging.
Right. And this brings us to the third major mistake investors make, which is confusing product availability with actual portfolio expertise.
Let's define the terms first, just for those who aren't, deep in the weeds on this stuff.
Sure.
Gift City is a financial hub in India specifically designed to facilitate international investments.
Right.
And a wrapper is essentially just the legal and financial packaging that holds the investment.
Right.
It's the legal vehicle, the box the investment comes in. Exactly. So a Gift City wrapper is essentially just a standardized shipping container.
That's a great way to put it.
It makes transporting the investment across borders highly efficient from a tax and regulatory perspective. It's a great tool.
It is. It's very efficient.
But the container itself is irrelevant to your returns.
Right.
I mean, a pristine, high-tech, tax-efficient shipping container filled with absolute garbage is still just a box of garbage.
That is the perfect way to look at it.
Mhm.
Access is not the same thing as skill.
Wow, access is not skill.
Right. Do not assume that just because a fancy Gift City product exists, it automatically delivers actual, high-quality, global diversification.
Right. Because if the wrapper is just the legal shipping container, I'm guessing the real due diligence we need to do is on the firm's payroll.
Exactly.
Like, I shouldn't be asking my broker, is this a Gift City fund? I should be asking, does this fund manager actually have an office in Brazil?
Yes.
Do they have analysts in Switzerland who understand local mid-cap pharmaceutical regulations?
That is exactly the right metric to use. You would be shocked by how many expensive global funds are essentially just three guys sitting in a domestic office.
Really?
Yeah, just throwing darts at a board of offshore ETFs and charging you a massive premium fee for the privilege of using their quote-unquote wrapper.
Oh, that's wild, because global investing is genuinely complex. You can't just apply an Indian domestic market strategy to a European industrial market and expect it to work.
You cannot. It's a completely different game.
Right.
Mehra emphasizes that you need to rigorously evaluate the manager.
Mm-hmm.
You have to look past the shiny marketing of the global label.
Right.
You need to see if the manager has demonstrated actual skill across international markets over multiple years.
Not just a few lucky months.
Exactly. Managing a true global portfolio requires understanding vastly different regulatory regimes, wildly different geopolitical risks, and complex currency dynamics.
It's a lot.
If they don't have the broad research capabilities and the actual boots on the ground to understand, say, a logistics firm in South America,
The wrapper means nothing.
it means absolutely nothing. You are better off not playing the game at all.
Okay, so let's summarize the architecture we've built so far.
Sure.
We are investing globally as a structural necessity, not an emotional reaction.
Sure.
We are doing it to hedge against the mathematical reality of inflation and currency depreciation.
Yeah.
We recognize that the U.S. market is just one cycle and we need exposure to rotating global leadership.
Yep.
And finally, we are meticulously vetting the manager, not just buying a shiny shipping container.
That is a phenomenal structural setup. You have built a resilient ship.
Great.
But a ship is only as good as the captain's ability to withstand a storm.
Oh, boy. Which brings us to the final and honestly the hardest piece of the puzzle.
Investor psychology.
Yeah, and surviving volatility. Because we all know it happens. You do all this research, you hire the right manager, you build the beautifully diversified global portfolio, and a month later, the market tanks. Your screen goes red.
Oh, yeah. This is where theory violently meets reality.
It really does.
And the notes address a very specific psychological trap here. The urge to panic sell after a drawdown.
It's so tempting.
Mehra's advice is incredibly blunt, and honestly, it is the golden rule of investing. She says, do not compound a bad buy with a bad sell.
Don't compound a bad buy with a bad sell. Why is this so much harder with global investments, though?
What do you mean?
I feel like when an investor buys a domestic stock and it drops 15%, they hold on. They ride it out.
Usually, yeah.
But when they finally take the leap into a global fund and it drops 15%, they immediately hit the eject button. Why the difference in behavior?
It's the psychology of unfamiliarity.
Unfamiliarity.
Think about it.
Mm-hmm.
When you buy a domestic stock and it drops, you still see the company's products on the shelves every day.
Right.
You see their billboards on your commute. You have a deep cultural understanding of their staying power.
You know they aren't going bankrupt tomorrow.
Exactly.
Yeah.
But when you buy a global fund holding companies in France or Japan, and it drops, that unfamiliarity breeds intense panic. You assume the absolute worst because you can't see the underlying businesses.
Ugh. Out of sight, out of mind. Or in this case, out of sight, total panic.
Exactly. But you have to remember, a global allocation must be judged over a full economic cycle.
Which is what, like 5 to 7 years?
Roughly, yes.
Yeah.
It cannot be judged over a temporary 6-month market dip.
Right.
Discipline has to override that emotional discomfort of the unfamiliar.
But let's be real for a second. It is incredibly hard to maintain that Zen-like discipline when you turn on the news.
Oh, absolutely.
The sources talk about the necessity of ignoring geopolitical noise when constructing and holding a portfolio.
Right.
And I have to ask a highly practical question for the listener.
Okay.
How can a regular investor actually ignore the terrifying 24/7 geopolitical news cycle? It feels impossible.
It does feel that way.
You open your phone, and the headlines are screaming about trade wars, actual ground wars, unprecedented elections, global crises. What is the mental trick to actually look at that and not panic sell?
It is difficult, I won't lie. But the mental trick is learning to ruthlessly separate the headline from the balance sheet.
Separate the headline from the balance sheet.
The notes explicitly state that long-run market outcomes are driven by fundamentals and corporate earnings.
Right.
That is your anchor in the storm. Geopolitics only matters to your portfolio if it actually affects your investments through specific tangible channels.
Okay, so it has to have a real impact.
Right. Mehra points out the main channel you need to watch: earnings transmission.
Okay, earnings transmission. That is the key phrase. Let's anchor that in a tangible scenario so we know exactly how to use this mental trick.
Sure. Let's use a real-world hypothetical. Let's say there is a massive disruption in the Suez Canal.
Okay.
A ship is stuck, or there is a geopolitical conflict in the region halting traffic. It is incredibly scary, and it dominates the global news cycle for weeks.
Yeah, the headlines are screaming about a global supply chain collapse.
Right.
And my instinct is to log into my brokerage and sell everything.
Exactly. But stop and ask yourself about earnings transmission. Does this specific scary news event actually change the amount of money the companies in my portfolio will make this year?
Right, okay.
Let's say your global portfolio is heavily weighted toward US-based enterprise software companies that deliver their products entirely via the cloud.
Okay, so software companies.
A delayed cargo ship in Egypt does not change their quarterly software subscriptions.
No, it doesn't.
It doesn't impact their profit margins. There is absolutely zero earnings transmission from that crisis to your assets.
Wow, okay.
The event is tragic, it is newsworthy, but financially, to your portfolio, it is just noise.
So you have to look for the literal causal link to the cash register.
Exactly. Now, conversely, let's say you own a European auto manufacturer that relies on physical parts being shipped from Asia on a just-in-time schedule.
Oh, boy.
Right. That Suez Canal disruption means their assembly line physically stops working. They have no inventory to sell.
And then there is massive earnings transmission.
Yes, that is a fundamental hit to the business, and that is a geopolitical event you actually need to react to.
That is incredibly empowering because it shifts you from being a passive, terrified victim of the 24/7 news cycle to an active, cold-blooded analyst of your own wealth.
That's exactly the mindset shift you need.
When a crisis hits, you stop asking the vague question, is this news bad for the world?
Right.
And you start asking the highly specific question, does this news actually transmit to the earnings of my specific assets?
And when you combine that analytical, earnings-focused mindset with the emotional discipline to not panic sell during a temporary drawdown,
Yeah.
you finally have a truly resilient global strategy.
Okay, let's bring this all together. We have covered a massive amount of ground today, completely rethinking the standard approach to international markets.
We really have.
Let's synthesize the ultimate playbook for you, the listener, based on Devina Mehra's insights.
The playbook is clear and structural. First, acknowledge the math. India is less than 3% of the global market cap, and inflation differentials mean rupee depreciation is a mathematical reality.
So it's not a fad.
No. Therefore, global investing isn't a trendy fad or an escape hatch. It is a structural necessity to shield your long-term purchasing power.
Okay. Second, break the global equals U.S. habit. The U.S. economic weather is just one cycle, heavily tied to Fed interest rates.
Exactly.
True diversification requires exposure to different countries, different sectors, and different asset classes, because as we saw in the 2000s, market leadership is always rotating.
Third, demand actual expertise, not just legal access.
Right, the shipping container.
Don't be fooled by the shiny shipping container of a Gift City wrapper. You are hiring a manager, so look at their payroll.
Good point.
Make sure they actually have the global research capabilities and the boots on the ground to navigate complex international markets.
And finally, build your psychological armor. Judge your international portfolio over a full 5 to 7 year cycle. Never compound a bad buy with a panic sell just because the geography is unfamiliar.
Crucial advice.
And relentlessly filter out the terrifying geopolitical noise by focusing only on one question. Does this event actually transmit to corporate earnings?
If you follow those rules, you aren't just reacting to the market. You are structurally positioned to benefit from it, no matter what happens in the headlines.
Which brings us back to that massive, sprawling shopping mall we talked about at the beginning.
Ah, yes, the mall.
You've walked past the first 2 stores by the entrance. You've actively decided not to just camp out in the giant American megastore in the center.
Right.
You have your structural shield in place, you have a skilled manager, and you are ready to explore the rest of the 97%.
The whole world is open.
It really is. So I want to leave you with a final provocative thought to mull over.
Okay.
We know from today's sources and our look at historical cycles that market leadership constantly rotates. The winners of the last 10 years are rarely the winners of the next 10. So as you look at your own portfolio today, ask yourself,
Yeah.
what totally overlooked region, what quiet country, or what completely ignored asset class in that massive remaining 97% of the global market might be quietly gearing up to be the next decade's undisputed leader, while the rest of the world is still staring blindly at U.S. tech stocks?